Market volatility can be a cause for concern when it comes to your retirement income, but there are steps that you can take to ensure that you can maintain your retirement lifestyle. My name is Michael Carbone. I'm a chartered financial analyst and a certified financial planner in the greater Boston area, and I help pre-retirees and retirees across the country to reduce their financial anxiety and to put the odds of long-term financial success in their favor. In this video, I'm going to discuss how to protect your retirement income during periods of market volatility. In your search for financial stability in retirement, diversification is always your anchor. By allocating your money across different types of investments like stocks and bonds, you can mitigate the overall impact that volatility has in your portfolio. Diversification creates a buffer, allowing for some investments to potentially flourish while others may be facing headwinds. The cornerstone to any well-formulated retirement strategy is a robust asset allocation. An asset allocation is simply your mix of investments across different asset classes like stocks and bonds. Properly allocated assets in retirement can significantly increase your odds of preserving your income in retirement. To achieve this balance, I believe that investors should seek to understand what the optimal balance is for them between investments that are geared towards growth, investments that are more income-oriented, and investments that are designed for preservation. The proper allocation should ultimately align with your need to grow your money to offset your ongoing and future expenditures in retirement and inflation on those expenditures, your need to spend your money over the near term, your liquidity needs, and your personal willingness to accept risk and experience volatility. And each of these three considerations may trade from one another. So, for example, if you have goals that require a lot of growth in your portfolio, that would suggest that you need to take a lot of risk. But if at the same time you have very high liquidity needs over the near term, then you really can't afford to accept that risk, because if the high risk in your portfolio leads to market volatility during a down market and you need to spend that money, then you can see how that wouldn't work. So the goal of this process is to find the optimal balance based on your situation. Once you determine the appropriate asset allocation, the next step is to identify the specific investments that you'll hold to implement that asset allocation. Retirees will commonly favor investments that offer an income stream as a source of investment return. For example, many stocks pay dividends, and although dividends are by no means guaranteed, they can be cut or omitted at any time, they can often be a reliable source of income even during recessions. Dividend stock investments that are more diversified, say if they're held in a mutual fund or an exchange-traded fund or an ETF, may be more likely to continue paying a dividend or some level of dividends even during a period of economic stress. But if you're looking at investing in individual companies, it would be worth doing some investigation or due diligence on how that company's dividend is held up during past economic recessions. Another strategy that's pretty basic, and I think that a lot of retirees will overlook it, is to consider carving out a bond ladder. Bond investments can generally be purchased through different types of vehicles. So you can buy a diversified bond portfolio through a mutual fund or an exchange-traded fund, or you can buy a bond directly as an individual bond. While diversified bond products like mutual funds can be really helpful for achieving diversification for your bond portfolio, or also trying to, achieve a slightly higher return over the long run through investing in riskier bonds or longer term bonds. They can also make it difficult for a retiree to manage market-related risks such as interest rate risk. Interest rate risk is the relationship that market interest rates have with the price of bonds. And so it's only relevant if you are buying a bond and you plan to sell it before it matures. So when interest rates go up sharply, bond prices will go down. And so the risk to retirees that have all of their bond money in bond mutual funds is that when interest rates go up, their bond funds are going to be down in value. And so since a bond fund is simply just a pool of bond investments that are constantly coming due, it doesn't necessarily have a definitive maturity date. And so by having all of their money in bond mutual funds, they don't necessarily get that benefit of being able to simply buy a bond and hold it to maturity and then get their money back. So what retirees can do is to carve out a portion of that bond money and put it into a 1 through 5 or a 1 through 7 year guaranteed bond ladder. So to do this, all you're doing is taking a lump of money and dividing it by the amount of years that you have. It's really straightforward. So say, using the example, the 5-year bond ladder, say you have $100,000 and you want to do a 5-year guaranteed bond ladder, you're taking $20,000, putting in a 1 year, $20,000 putting in a 2 year, and so on and so forth. So in 1 year, you'll have $20,000 that comes due. If you have other money that you can spend, then that's fine. If not, you can spend that. If you don't need to spend it, you can just move it out to the end of the ladder. Guaranteed bond ladders can help retirees to increase their ability to fund their short-term spending needs regardless of what's happening in the market. Another thing that's really important for retirees is during periods of market volatility to remain focused and to not make impulsive decisions based on short-term market fluctuations. Short-term market moves are notoriously difficult to predict successfully over time, and the reason for that is because markets are forward-looking. So not only do you have to predict what's going to happen, but you also have to predict what other people are predicting and how these people will react if they're right or wrong. This is not easy to do even for the smartest investors. Instead, I believe that a better strategy that has a higher likelihood of success is to stick to your plan and maintain discipline and remain as objective as possible. Another thing that retirees can do to insulate themselves from market volatility is to consider guaranteed income options. Annuities, for example, can provide a steady stream of income that's not affected by market volatility. Annuities often get a bad rep, and for good reason. They can be really expensive, they're hard to get out of, and they're almost always difficult to understand. This combination unfortunately sets them up perfectly to be used as a predatory sales tool. I believe that some annuities may potentially be appropriate if they're fully understood and they're being used as a hedge against longevity and not as a means to achieve any growth objective. I believe that a fair and reasonable way to view annuities is an investment product or an insurance product that investors can use to reduce their risk of living a really long time, to provide a steady stream of income, and to potentially earn a return on their money that's commensurate with, say, a guaranteed bond yield plus maybe some premium. Another really important way for retirees to protect themselves from market volatility is to get Social Security right and to maximize their benefits. Unlike a retirement portfolio, Social Security benefits are not subject to market fluctuations, which makes them a reliable foundation for a steady stream of income in retirement. This subject is really lengthy, so if you're interested in learning more about how to maximize your benefits, then here's a link. You can watch the video that I created a little while ago that's focused specifically on that topic. So in conclusion, market volatility is a natural part of investing, but it doesn't have to jeopardize your retirement income and your retirement lifestyle. By diversifying your investments, staying focused on long-term goals, considering guaranteed income options, and being smart about your Social Security, you can protect your retirement income and achieve financial security in the face of any market or economic scenario. And remember that planning ahead and taking proactive steps can make all the difference to ensure that you have a worry-free and successful retirement. I hope you got a lot out of this video. If you feel that you'd be a good candidate for a complimentary consultation with me, then follow the link in the description of this video and answer just a few questions. If you're a good candidate for a discussion, it'll bring you right to my calendar and you can set up a quick call with me. But I wish you the very best of luck, and I hope to hear from you soon.